Hello, this is Domenico with Easynomics, and we're going to be looking at Tesla as an applied real-world example within the market structure of oligopoly and how it can use its supernova profits to achieve economies of scale. Or in the case of Tesla, initially, it was operating at losses due to the heavy investment in achieving economies of scale. So we're going to illustrate an oligopoly at a loss and that loss driven by increased average total cost as a result of spending to achieve scale. This will be part of several playlists. One main playlist will be this one will be linked in the video notes below, which is just focused on monopoly and oligopoly market structures for IB assessments. So here we have Tesla as our applied real-world example. It produces and manufactures electric vehicles. They have different models, as we see here, and I'll get into that in a moment. And if we look at the business strategy, it highlights here how a main focus for Tesla was to achieve economies of scale so that it was viable and competitive with the other large oligopolistic car manufacturing firms. Here it says that at the time of Tesla's founding in 2003, electric vehicles were very expensive. So how was a small firm going to break into the car manufacturing industry? So their strategy in 2006, Elon Musk stated that Tesla's strategy was to first produce high-priced, low-volume vehicles, a low quantity sold at a higher price, a luxury sports car. With those luxury cars, PED is more inelastic. People buying these high-end sports cars are less sensitive to price, so a great strategy to start off with. This would allow Tesla to progressively bring down costs of batteries as they were able to begin to build viability for their business, market their company, or build their brand name, get investment, get also government subsidy, and with that streams of revenue coming in, invest in achieving scale. So here it says it would allow them to offer cheaper and higher volume cars over time. Tesla's first vehicle was the Roadster, low volume, only 2,500s were produced, that was the quantity, and it was priced at over $100,000. And over time, they now offer the Model S, the Model X, the Model 3, and the Model Y. And as they're able to increase output, achieving 100,000 cars produced per quarter every 3 months, they can reduce costs on average and lower price and achieve what we call economies of scale. That economies of scale was achieved by acquiring larger factories. So here we see the facilities in 2010. Tesla acquired the Tesla Fremont factory, 22,000 employees, producing the Model S, X, Model 3, and the Model Y. They also want to reduce the cost of their most expensive inputs, such as batteries. So in 2016, they built their Gigafactory in Nevada to reduce the battery costs per unit. And in 2017, another Gigafactory. In 2019, another Gigafactory in Shanghai, where they're also producing the Model 3 and the Model Y. So here they're building their scale by increasing their capital resources, such as factories. In addition to that, we can see vehicle sales over time. And initially in 2012, we see low volume, low quantity. Here's the Model S. The Model S is a sedan vehicle priced at about $66,000 approximately. And as they're building up their factory production scale, we can see they're able to offer the Model X and eventually here we see the Model 3, a more affordable model, pricing at about $35,000. And they get to the Model Y, which is priced about $31,000. And here we can really see the volume, the quantity of the cars really increasing dramatically. And as they're able to produce more units, the cost per unit falls, and so they can lower price and start to achieve greater profit. At this point, we see that they're achieving 300,000 cars per quarter, going to about 400,000 cars per quarter. Down here, it says that Tesla's deliveries vary significantly month to month, but on March 9th, 2020, as a result of a decade of building scale, they produced their 1 millionth electric vehicle. And in the third quarter of 2021, they built their 2 millionth electric vehicle. So this is all an example of economies of scale. How was this achieved? If they were operating at losses initially, and if I go back, actually, I can show that. I think I had down here. Yep. Here we can see that they were operating at a loss. Net income, negative 12 million, negative 30, negative 78, negative 83, negative 56. losses, losses, and losses for about a decade, over a decade, before they start to generate a net profit. Okay. How were they able to operate at a loss? Well, they got subsidies. The Department of Energy offered them a low interest loan, $465 million in 2009. In addition, they got investment by listing on the NASDAQ and being listed as a public company. Okay, so let's get into our model. So graph A is the individual firm. It is Tesla as an oligopoly within the car manufacturing industry. Graph B will illustrate economies of scale achieved by Tesla in the long run. Some vocabulary. Down here we have economies of scale, which is reducing average total cost per unit, achieved as a result of increased output in the long run where all factors of production are variable. Okay, so that's our first key term. And this is internal economies of scale because it's Tesla itself as an individual firm achieving scale. It's reduced average total cost resulting from the increase in the long run scale of production of a particular firm. So that's what we mean by internal, a particular firm. And that's achieved through specialization in labor. As it gets larger and larger, it can achieve managerial economies of scale, getting more specialized labor, as opposed to when Tesla was smaller, maybe a small firm, you might have one individual doing multiple tasks. But as you get larger and larger, you can get a specialist in a particular area that can just focus on managing a team, hiring the best engineers, and so on. Then we get specialization in capital goods. As they get larger and larger, they can afford to buy specialized machinery, such as robot technology along their assembly line, which is what we call technical economies of scale. Also, internal economies of scale can be achieved through marketing. As you get larger, more money can be spent on advertising and marketing to change tastes and preferences and alter the non-price determinant of demand. But from my knowledge, Tesla does not spend money on marketing, so that is not one of their expenditure points. And last, we have purchasing power of the firm, that as they get larger, they have monopsony power. They're able to negotiate harder with their suppliers and reduce the cost per unit for their inputs. But because they're buying such large volumes of inputs from their suppliers, they can really negotiate hard and reduce the cost per unit of input, thus achieving purchasing economies of scale. So graph A, let's illustrate Tesla operating at a loss and how that loss is generated from them constantly trying to spend money on achieving economies of scale. So first we'll draw our supply curve. Here we have the law of diminishing marginal returns, creating this backward J shape. We'll call that supply curve equal to our marginal costs of production. And that will intersect with our average total cost curve. And I'll draw that a little bit higher since I want to illustrate a loss. So the ATC will go down and it will start to move back up once it intersects with the supply curve. I'll link a video that explains that relationship between marginal cost and average total cost, and how if the marginal cost is less than the average, it pulls the average down, and if the marginal cost is greater than the average, it pulls the average up. Okay? And then we'll illustrate our demand curve. I'm going to intentionally draw Tesla operating at a loss. Actually, give me a moment here. I'll make it slightly more inelastic. So here we have their demand curve. Demand equal to marginal benefit. And then we'll illustrate the marginal revenue curve here. And I can link another video to explain why the average revenue is greater than the marginal revenue. So here we have our marginal revenue curve. And demand is equal to marginal benefit, but it's also equal to average revenue. If I can draw that a little bit better there. Okay, so we assume profit maximization or loss minimization, and that's achieved where MR equals MC at this point. So we'll illustrate quantity of output there. We're minimizing our losses at quantity. So it's quantity profit max or loss minimization, and they'll price according to their demand. So I'll call this price 1 equal to average revenue. It's average revenue. And then we can see a loss generated. Here's the cost per unit at that quantity of quantity profit max. Here's the cost per unit. Average total cost greater than average revenue, so the firm is generating a loss. So let's illustrate that and fill that in. Okay. So here they're operating at a loss during all those years. And that loss is a result of Tesla driving up their costs, their ATC, which also affect their supply curve. It's driving their costs up because they're investing and achieving greater economies of scale. Okay. I can also highlight here, just so that you can see this as a talking point for your evaluation, the welfare loss. So here's marginal benefit, here's marginal cost, and this is where MB will equal MC to be allocatively efficient. So let's also be able to visually identify the welfare loss here. Okay, so on graph B, let's illustrate economies of scale. And let's start off with the first model being the Roadster. Okay, so I'll have a point perhaps here. All right, and this point is illustrating Tesla's initial car of the Roadster. And the Roadster was priced at about $100,000. So a very expensive sports vehicle. That price, that selling price, is a reflection of its costs of production. So here we can have high costs and low output, 2,500 cars produced. So here we'll have quantity 1, low volume, with high costs leading to a higher price. Then over time, as they were able to acquire that factory in Fremont and increase their output and produce the Model Sedan, or the Model S, then we have a lower priced vehicle. So we'll get to this point here, and we'll label this the Model S. And the Model S was sold approximately $66,500. That's an approximation. And that gives us a lower cost and more output. Q1 to Q2, cost on average falling to C2. Then over time they continue to invest and they're able to produce, let's say, the Model X, slightly cheaper. And that was priced about $64,000. It's an SUV type. That was $64,000. And that gives us a lower price due to a lower cost, and that's a result of more output. So here we have C3 and more output at Q3. And then we get to the Model 3, their next model. Here, let's choose perhaps maybe a dark gray. Let's really choose this point here. We get to the Model 3, and that was priced about $35,000. That price is a reflection of its cost. Lower cost, lower price due to more output. So here we have the cost falling to C4 and output increasing to Q4. Then finally we get to the Model Y. What color should I choose? Perhaps I'll choose red. Here we get to the Model Y. And that's priced at about $31,500. And that's a reflection of its cost. Let's choose this. So reduced cost at C5 due to the vast volume of output, 300,000, 400,000 cars produced per quarter. So here we have Q5. So this is illustrating that over time, in the long run, costs on average are falling as output is increasing, and that is the long run average total cost curve that illustrates economies of scale. So the LRATC curve would be connecting all these points. Okay, and maybe you get to minimum efficiency, and then it would start to rise again if there was diseconomies of scale, and we would label this long run average total cost curve. Okay, so this is a connection between Tesla as a firm operating as an oligopoly, generating loss due to increased costs of production as they spend money in building their scale, and that is leading to costs on average falling from C1 to C5, leading to increased output from Q1 to Q5, which is good for the consumer because you get a lower priced electric vehicle, falling from $100,000 per vehicle to $31,000 per vehicle. And I'm sure Tesla's goal is to get to a $15,000 electric vehicle car, where they'll really get increased demand because it's incredibly more affordable at that price. I'll create another video where I'm just going to simplify the economies of scale model that I can use for a paper assessment. And on an IB exam for higher level students, you can discuss that. Even though you're not required to illustrate an economies of scale model with the new syllabus, you can go ahead and draw it because it's relatively simple to draw. So there'll be another video just simplifying the LRATC curve, simplifying 2 points, C1, maybe C5, Q1, Q5, as a talking point for your evaluation of the benefit of an oligopoly achieving economies of scale or a monopoly achieving economies of scale. And that's it. If you have any questions, feel free to comment those questions below, and please don't forget to subscribe and to like. Thank you so much.